Welcome to another episode of Niche to Necessity. Today we have a special guest, Nik Crypto Nik Fahrer. He's a CPA and he is the man spearheading the digital asset practice at Forvis, which is a top 10 accounting firm. Welcome, Nik.
Yeah, thanks for having me, Taylor. Super excited to talk to you today.
Yeah, really glad to finally have you on this show. Would love to kind of get a little bit of sense for our viewers, just kind of how you got into the world of accounting for digital assets, and kind of like, what was that aha moment for you?
Yeah, definitely. My story goes all the way back to 2014. I was living in Dallas at the time. I grew up in Indiana, reconnected with another friend that also grew up in Indiana while I was in Dallas. We went to a Texas Rangers baseball game, and he's sitting there talking to me about Bitcoin. And the way he just talked about it, he was super convicted, and he just believed with the utmost certainty that Bitcoin was the future. And I am unhappy to tell you that I laughed in his face and just kind of told him, like, listen, this isn't going to go anywhere. I don't really believe in it. You're crazy. All those sorts of things that people go through, right? And to give him credit, he not only did he tell me with conviction that Bitcoin is the future and all this stuff and try to get me into it, but he did also tell me to do my own research. And so, we stayed in touch for the next few years, and finally in early 2017, out of spite to prove him wrong about his conviction with Bitcoin, I decided to do my own research. And I went down the rabbit hole and, watched several Andres Antonopoulos videos on YouTube, crypto Twitter, all sorts of things. And the realization I came to was like, wow, this guy's right. And I should have been listening to him all along. So I ended up buying, my first fraction of a Bitcoin in 2017 on GDAX, back whenever it was GDAX. And like I said, to my friend's credit, he told me to do my own research, and he also didn't let me stop by just buying Bitcoin on GDAX and leaving it there on the exchange. He highly encouraged me to perform an on-chain transaction, stored in self-custody. And through all of that process, I just learned a ton about Bitcoin and crypto in 2017. So I remember it clear as day. I approached my firm afterwards and just said, hey, can I write an article about Bitcoin? I just learned a bunch about how it works, all these different things, just did all this research. I think that, this could add value to our clients. And they agreed. We're an big accounting firm, so we're conservative. So luckily they agreed. And when it was finally published, it actually took a long time to be published. I think it came out in early 2018 because of all the risk reviews that it went through. But when you write an article in a firm, you almost instantly become the quote unquote expert. And in reality, I was a nobody. I had just a few years of experience. But partners now were in the firm coming to me with questions where they had, clients with crypto and didn't know how to handle it. And so, I learned a lot through just saying yes to those questions whenever partners would bring those clients to me. And I'm pretty sure I blew the budget on the first couple of clients that I worked on, because actually I know I blew the budget just because I was trying to, figure out exactly what all goes on, but just gain experience that way. So that's kind of high level my story.
Yeah, I love it. I mean, the quickest way to get noticed anywhere is to go into a niche that nobody else knows about. And so it sounds like you kind of hit that one right on the head. My second question was about kind of how you decided, or what inspired you to spearhead that practice at Forvis. It sounds like you kind of you nailed that one as well. What would you say are some specific accounting practices or traditional accounting practices that are disrupted by digital assets, or that are made more difficult by digital assets?
Yeah, so there's a ton of misconceptions, and I'm going to sound like a broken record on this podcast today, or on this recording today, because in my opinion, I think the best thing that people can do is get their hands dirty. That's what I did whenever I first got started. That friend told me to perform an on-chain transaction, self-custody, all those sorts of things. And even to this day, that's still how I learn about this space the most, is I'll go in and get my hands dirty. So like, if you think about DeFi summer in like 2020 and 2021, and then the NFT craze and all those sorts of things, I was going in and playing around with some of these protocols, learning how to, provide liquidity to a liquidity pool, how to own an NFT, how to stake, all these different things that people talk about that are in the ecosystem. And I still highly recommend, if you're going to be a part of this space, you need to get your hands dirty. You need to actually understand the mechanics of how these things work. And there's such a learning curve when it comes to the portfolio of words that we use in this space. I mean, staking, like, what, I'd never even heard of that word before, entering the digital asset space. So there's a huge learning curve, and I think getting your hands dirty is the best way to get involved and understand what you need to do to be prepared for whenever clients come to you with these questions.
Yeah, I mean, I got involved in the space in 2018, like early 2018, and when I was on as CFO of TrustSwap, we launched July 2020, so it was like right in the heat of DeFi summer. It was right when Uniswap had its airdrop in September, right after that, and it being at a high level in a firm, in a startup like that, you have to be involved in those DeFi transactions. And there was no guidance on how to account for any of these things. So we were providing liquidity to LP pools on Uniswap. And so it's like, all right, well, who else is going to figure out how to do the accounting for it? You kind of have to get your feet wet and actually do this stuff and realize, okay, what traditional assets can I compare this to kind of draw a line in the sand? And still a challenge, but you kind of have to put on your accounting theory hat a lot of the time and just kind of demystify the blockchain aspect of it. But I agree completely. The only way to really learn in this space is to do it and to have that experiential knowledge of actually performing the transactions. Otherwise, it's really hard to have it all up in your brain without any actual visual representation of it. So
and I don't know about you, but how many times did you go and try to do like an on-chain transaction, whatever it may have been, and you like not only double checked it, but triple checked it, quadruple checked it, just because, like, if you click that send button, there's no going back.
Yeah.
And there's just a huge learning curve when it comes to working with these new protocols, because you're really just watching YouTube videos from other degens, if you will, that have already done it before you have. So it's kind of scary in a certain respect.
Yeah, and one exercise that I did when I was first getting started with DeFi was like, I mapped out in Excel like a formula for how the price would change based on different values in, like, for the automated market maker, because essentially it's a numerator and denominator transaction, right? So those types of things too, where you're like, okay, how much liquidity do we need to move the price by this much? And analyzing that sort of stuff helps you really get into the details of like, okay, how is this operating under the surface? So we really get a better handle of what's really going on there. So yeah, totally. So within Forvis, how has the company as a whole adapted to, both its services and also kind of maybe some of the inner workings of the firm to accommodate the shift towards digital assets?
Yeah, absolutely. First of all, I think education is a huge key here. You and I have been in the space for a long time. We know that there's a ton of misinformation out there. I think the Wall Street Journal article that came out in the last month that cited the, illicit activity that Hamas was using in crypto, and then that being the only source for a letter that was signed by over 100 people in Congress. And then later the source of that Wall Street Journal article coming out and saying, no, that was completely misrepresented. That's not actually what happened. All those things happen all the time. And in fact, I was presenting at a conference this past week about crypto, and a gentleman came up to me afterwards, and he was telling me this story about how he was a CFO for a large franchisee, and several years ago, they were hacked, and the hacker demanded ransomware, or sorry, a ransom payment in Bitcoin. And because of that, he associated the hacker with Bitcoin and now thinks that Bitcoin is inherently bad, and will never overcome that hurdle because of that experience that he had to go through, because he had to figure out how to come into ownership of Bitcoin and then send it to the hacker. And at one point in this story, he's telling me this, he was calling it a Bitcoin hacker. And in my mind, I'm just like, you know, this whole story just got so derailed because this person associates Bitcoin with somebody that hacked his business, which is unfortunate. And I think we're starting to see a lot less malicious activity on Bitcoin and other public blockchains because all the transactions are traceable. So education first, right? And educating our people. Second, I would say client acceptance is huge when it comes to figuring out who we want to work with. And to go a little bit further into why that's important. So first of all, we want to make sure, is this a client that we want to work with? And if we do, what are the risks if we do work with them, right? So we're asking things like, what experience do they have? What kind of records can they provide? Do they have a history of non-compliance? Are they coming to us to solve all of their problems, or will they take ownership over the problems? And can we then just be their trusted advisor? What type of controls do they have in place? But then, you know, on the flip side, you know, we're also asking ourselves, do we have the necessary skill set to serve this client at a high level? Do we have capacity to serve the client at a high level? All this goes into, you know, why we have a client acceptance policy to begin with, is just to manage risk, because we want to work with like-minded people. We want to be a firm that people associate with helping this industry mature versus just, you know, a firm that can crank out a tax return or some financial statements or whatever it may be that the client needs. We want to add value to the industry. We want to add value to our clients. And so, you know, that's why client acceptance policies super important to us. And I know several other firms also have a client acceptance policy. In fact, there was one firm, I won't mention any names, but they were an auditor of a crypto firm, and that crypto firm ended up doing some shady things, and the accounting firm, their insurance provider, went to them, and I'm paraphrasing here, and basically said, you guys can continue to serve clients in the digital asset space, or you can have insurance. And so I think that public accounting firm decided, okay, we'll divest our digital asset book of business. So there's a lot of risk that goes into working with clients in the space, and that's because we've had some bad actors in the past, which is unfortunate.
Yeah, it's I think having a policy like you're stating is really important, because ultimately you're going to have a lot of people who are shopping around for advice as well, right? So people who want to hear a certain type of answer, so they're looking for a firm that will give them that answer when it may not be the right one, because they don't either like the, you know, there are people who still try to argue that, you know, you don't have any gains or losses or any reportable transactions until you cash out to fiat. Like, that's one of the biggest myths I hear all the time, people using. And it's like, if you're in the US, that's just not true, right? You know, we have to report crypto to crypto swaps. We have to report all these things. So if you're not willing to kind of work with us to get yourself in compliance, you know, then it's hard to work with a client at all. And, you know, also, if you have a client that doesn't have good records, it's a lot harder to complete that return, because you're going to be finding out that, okay, well, the ins and outs don't match up. You definitely have some more wallets. Where are they? And so that adds time, and it adds to the scope of it, which is harder to tell the client at the end of it as well. So really important to have those types of policies to protect your firm and to make sure that you're going in the right direction, you know, as a firm as well. So as far as like within your firm, you know, how do you find the learning curve is for professionals within the firm that aren't kind of working in digital assets or aren't familiar with crypto to learn how, and does it vary based on their kind of generational gap? Like, do you see it harder for maybe some of the boomers in your office to adapt this, or, you know, I don't want to want to throw you under the bus at all either, you know, because I'm sure some of your partners are boomers, but like, is it harder to educate them or get them on board? It sounds like your firm was relatively receptive, but, you know, can you talk to a little bit to the educational and the learning curve aspect of it?
Yeah, absolutely. I think frankly that there are people in any firm that just don't want to learn certain things in their
Mm-hmm.
careers.
Mm-hmm.
Maybe they're towards the tail end of their career and they see this as a new technology and they don't see it as maturing enough to where they're going to need to understand it before they retire. I also think it's probably more, you can probably generalize it more in two buckets, is the people that are tech forward and the people that aren't tech forward. So the people that
Mm-hmm.
are more tech forward are probably more likely to want to learn and adapt a lot easier. And actually one thing that we did is we developed an internal, what we call a digital asset tax team. And this team is made up of specialists from all over the firm, but focus in things like international, state and local tax, federal tax, controversy. So, you know, representing clients if they receive a notice, things like that. And so we all come together on a regular basis. We also share the workload, and that team is made up of pretty much every generation that's in the workforce right now. So it's been great. One thing I do wish is that there was a little bit more diversity in digital assets. I think men are more likely to want to learn about it and understand it more, and I think the statistics would show that too. And I wish that, you know, we could shorten that gap and there would be a little bit more diversity in this practice. And I do work with some clients, their CFOs are women, so they're there. It's just at a higher level in men than women right now. And again, like I said, I was going to sound like a broken record, but one of the things that we did with the digital asset tax team, whenever we first created that team, to get the entire team educated and on the same playing field, is we said, take $25 and go perform an on-chain transaction and come back and present to us what you did. And that's basically all the parameters that we gave them. And that's because I believe in, and we believe in, getting your hands dirty and truly getting involved and understanding how the mechanics of these things work.
I gotta get you guys in front of the trip around the cryptoverse I'm launching tomorrow. It's basically the same what you're describing. We go through everything from on ramping fiat to opening up a non-custodial wallet. We do DeFi swaps, lending and borrowing, liquidity providing, and then NFT purchasing, and then we reconcile it all by like tracking it all on chain. So I gotta get you guys into that course as well. I think it'll help anyone else that you're adding into it is that's joining the firm that wants to join your practice specifically related to digital assets. So we'll talk more offline about that.
Yeah, absolutely. Would love to. 3 hours of CPE too, right?
Yep. That's happening tomorrow, and then we'll do some replays of that eventually, and it'll also live in this CryptoCFOs community. So if people want to do it on replay or pause and all that, they can access it that way as well. So so as far as the regulatory environment for digital assets right now, we know that there's a lot going on right now. We had that the Hamas issue with like all those signatures that you alluded to earlier in the call. Could you share your kind of general perspective on the current regulatory environment for digital assets? Do you think it's moving in the right direction? Do you think, you know, maybe there's still not enough clarity? What do you think about all that?
Yeah, absolutely. I think in a lot of ways that the industry has really been calling for regulation in the US for years. There's a ton of ambiguity right now. I think it's maturing, but in the US, we still have a long ways to go. You've seen other countries and other jurisdictions more forward on this and seizing the opportunity. The EU, the UK, Singapore, and then places like places in the Middle East, like Saudi Arabia and those countries as well. So there's a lot of countries that are ahead of the US right now from a regulatory perspective. And honestly, I think what happened to FTX really set regulation in the US back probably by years. And it created a lot of trust issues. Sam was the poster boy of crypto at the time. And unfortunately, there was a lot of people on the Hill in DC that trusted in him and believed in him. And when he broke that trust, it's almost like those trust issues were then just transferred over to the rest of the industry, which is unfortunate. And honestly, the whole thing with Sam and SBF is ever since he was tried, I honestly haven't been keeping up with it. And that's because I feel like we should be focused on how we can build and continue to help the industry mature, as opposed to focusing on, what's going to drive a headline. Mm-hmm. Right. So, we understand that there's a ton of gray area when it comes to the regulatory guidance, especially, IRS, and accounting as well. And we feel like it's important for our clients to present all of the options and then let them decide what's applicable for their risk appetite, if you will. So maybe one example is the IRS this year came out with, I think it was IRS notice 2023-27 about treating NFTs as collectibles. And basically in that notice, they say that they want to create a regime where you look through the NFT to decide if it's a collectible or not. And if it is, then there's potentially a higher tax rate. Well, that notice is really only applicable to the IRS themselves, and can still be challenged in court. And it also asks for comments. So to say that that's final authoritative guidance that can be relied upon is not necessarily the right case. And so there's gray area there. Do you treat it as a collectible? Do you not? Well, we can present those facts to our clients and let them decide based on their risk appetite. It could very well be the IRS eventually comes out with authoritative guidance and says, yes, they are collectibles, in which case the client would have some exposure, but at least we presented all the options to them.
Mm-hmm. Yeah, super important, because people are going to have different risk appetites. Some people are going to want to be ultra conservative and be in that kind of wheelhouse, and other people are going to want to have their kind of take that risk and maybe pay the price later if it goes sour, but are willing to do that. So that's important to be informing clients like that. That's great. So as far as Forvis as a firm, how does the firm navigate the complexities of compliance for both yourselves and for clients? How do you guys have a framework for how you go about that?
Yeah, absolutely. We've developed an internal framework. I mean, we've documented pretty much all of our positions and all of the gray areas. One thing that's really cool that I think that we've done that I don't know a lot of firms can talk about is that we've actually developed our own blockchain application. We saw the value in these public blockchains being immutable. And so, we're organized as a partnership. And so whenever there's a vote up for the partners, we then record those partner votes in a blockchain-based app, and it's hashed and then written to the Bitcoin blockchain so that we can leverage that immutability of the blockchain. So, we have that real experience of developing a blockchain-based app, and we're drinking our own champagne, eating our own dog food, if you will, whichever one you like to use. And then, I think leveraging tools that are available in the market as well is super important. So, there's some really good crypto accounting subledgers available. And it's just a matter of working with the right ones. Some ones that we've used are Crypto, Bitwave, Coin Tracker, Legible, so on and so forth. I mean, we could probably list, 100 of them if we wanted to, but those are some ones that we've used in the past.
Nice. Yeah. Good choices for sure. I've heard great things about all of them. What would you say are some of the most common misconceptions or concerns that your clients come to you with about digital assets?
Yeah, I heard you say earlier that one common misconception that you are still seeing is that, you don't have any income or you don't have a taxable event until you liquidate back to cash.
Mhm.
That's still, I think, a common misconception, but I'm seeing that decline. I think that there's more and more education around, hey, all of these transactions, even if you trade from one crypto to another crypto, is still a taxable event. Um, one thing that I think is still a common misconception that I'm hearing in conversations is that, crypto is not traceable. I don't know what you're seeing, Taylor.
Yeah, yeah,
Um,
yeah. Yeah, I see that too. Yeah.
but but I think there are people in the market that still believe, hey, there's no way the IRS can track me down. There's no way the government can track me down. That's not necessarily true. I mean, if you have an on and off ramp like a Coinbase or a Kraken or whatever it may be, and they're doing KYC, the IRS has the ability to go in and figure out all your transactions basically. It's
Mhm.
pseudo anonymous. It's not completely anonymous. So I think that's a big one. And we just saw Kraken, right? They had to comply with a John Doe summons, and they
Mhm.
announced that they released a bunch of information on a lot of their
Mine,
clients.
mine included. Yeah, yeah. They contacted
So
me, letting me know that they gave up my data for sure. Yeah, I mean, I think that a lot of it has to do with, ultimately these, whether or not they have the capability to analyze it all and like do something with it right now doesn't really matter, because if you're underreporting by 25% or more, it extends the statute of limitation on that. If it's fraudulent what you're doing, just completely negligent, that can extend it even further. So, whether or not they can look at everything right now and track you down specifically in this moment doesn't really matter. They're going to have the capability, and they can leverage tools like Chainalysis and other kind of on-chain analytics firms that they can contract out to, that have very robust data on this stuff. So they may not be able to, like you're saying, it may not be 100% accurate, to be able to identify you, but they can get pretty close to 99.999%, right? That it's you. Especially, I would say the vast majority of people have done some sort of on ramp, either or off ramp, where they had to provide KYC. And so, very true that I think that that's another huge misconception in the space.
absolutely. That's interesting that you got a letter from Kraken in that too.
Mm-hmm.
A couple other misconceptions that I see, probably the biggest one when it comes to actual reporting, is that because crypto is treated as property, that you're only going to have capital gain or loss, which you and I
Mm-hmm.
know, right? There are instances where that's not true, and you could be reporting an ordinary income or loss,
Mm-hmm.
right? So things like staking or yield farming, depending on what your risk appetite is, are likely ordinary income activities. And so making sure that you report those correctly. It may not make a huge difference if you have a short-term capital gain, right? That's going to be taxed at your ordinary rates anyways, but that's a big common misconception. Missing it whenever it comes to the net investment income as well.
Mm-hmm.
Making sure that those capital gains and losses are reported on the 8960, but also that staking income and some of those other investment activities that you're doing, making sure those get captured on the 8960. And then I think just finally just understanding that there is no hard and fast way to treat a lot of these transactions. We do have some guidance, but there is still a ton of gray area. And so I think some of our clients assume that, hey, we have all the answers, we know exactly how it's going to be reported, but that may not be the case. We may be coming back to you, the client, saying, hey, there's some gray area here. What is your risk appetite, and how would you like to report these?
Yeah, I think that a good one for me was, uh, the transition from Uni V2 to Uni V3 really complicated things for me. Because when I first started in the industry, I was like, okay, for sure, when you're providing liquidity under Uni V2, like you're selling both of these assets, it makes sense to me that you're selling these two assets to purchase this other LP asset. But now that it's an NFT, you don't really dispose of that NFT when you go to reclaim those assets. So there's a lot of gray area. That's a good one that I use for an example, where it's like, you can it's not really entirely clear how we should be handling this from an accounting and tax perspective. So like you say, we need to go back to the client and say, here are the facts, here are what we think, and here's the different ways it could go. How do you want to proceed? I think that's always a good way to proceed as a practice in general.
Yeah, exactly. There's just so many, there's an endless amount of opportunities when it comes to this. And I mean, you could even get so granular to go in there and read the smart contract, right? And figure out what is exactly going on from a technical perspective. But I think it's also important to take a practical approach too. You know, some of these transactions may be so immaterial. It may be just better to just assume that you have zero cost basis and just reporting it all as a gain, versus, you know, paying my billing rate or your billing rate times the time it takes for us to go in there and figure out what it is. Like, you know, sometimes you
For a
just need to
$5
take
transaction, that may not make sense, right? You know, like, so yeah, totally. Yeah, I think that drawing a line there is key as well of what spending the time, what areas spending the time makes a difference and makes sense as well for client. Because, you know, when I used to do this all for my family when you know, because they were involved during DeFi summer, and so I would be, you know, this was before I was really familiar with, you know, the great tools that exist now for subledgers and for tax reporting. And I was doing it all manually in Excel. And so, you know, I'd spend 40 hours doing my own return because I had all these, you know, ins and outs and stuff like that. And obviously the tools make it a lot easier now, but it's important to make sure that the things you're looking at are material and not actually going to make a difference at the end of the day. So what are some innovative practices that Forvis has adopted in managing and reporting on digital assets?
Yeah, you know, I talked about one of those earlier, and, you know, just kind of drinking our own champagne. We built that own blockchain based app. Another thing that we do from a risk perspective is we have our own, what we call a concurring review. And anytime a client exceeds a certain threshold in digital asset activity during the year, we have that group, that team, that digital asset tax team, that act as, you know, subject matter specialists, and they're there to answer questions as the return is being prepared, instead of waiting until October 14th and the partner on the account being like, oh, hey, you know, by the way, I just noticed this client has crypto. Are we doing this right? And, you know, if they don't have any previous experience with crypto, chances are there's probably something that they may have missed. So that concurring review is a big part of our quality. And, you know, we really believe in instituting that practice so that we're catching things on the front end and not waiting until the last minute. So working with our clients as things are being prepared versus on the back end.
Yeah, I think another key aspect to that too is, like, I mean, there's a deal of client education, as we've kind of alluded to on the call already, where you have to kind of like be like, hey, a lot of this documentation is not going to need to be on your end because we're going to be relying on your description of what happened. So educating your clients on keeping good records themselves, it's just so much more important with crypto than it is for stocks and things like that, because, you know, generally people have you know, like a Fidelity account that's going to send them a 1099-B. You'll get a 1099-B from Coinbase or Kraken or whatever you use, but it's not going to capture all the information, and they don't really have a way to do that in an effective manner anyways. So educating clients as well and following clients along is so much more important in this space than it is in other spaces, just because this is the complexity of everything and the detail that can be involved with all this. So really cool to see you guys have a policy for that as well.
Yeah, while we're on the topic of 1099s, what are your thoughts on the proposed regs?
I mean, I think if passed as is, it would be terrible for the industry. But I don't see them passing as is. I think that they, you know, hopefully they'll listen to the comment periods. We kind of crafted one internally in the CryptoCFOs community that we need to send off. I think that having the way that they were originally drafted, it basically made something like MetaMask have a need to report, right? And so it's not really conceivable for that to happen. So it would effectively shut out any US based investor from participating if they want to be compliant. And so for me, I think it's ludicrous, but it's drafted by people who have limited understanding, I think, on the subject. And there's probably people who advise them on it that know about these assets. But if you wanted to stifle innovation, I feel like you implement these regs. If you want to kind of open things up a little bit more, and it's not that I think the industry as a whole doesn't want regulation. I think we just want sensible regulation that allows people to comply, but also doesn't overburden the industry. What are your thoughts on them?
Yeah, I generally agree with you. I think it would stifle some innovation. And frankly, when I take a step back and think about, okay, well, what is this really trying to get at? To me, it feels more like an AML policy than a 1099 reporting policy. And if you think about it, Treasury and the IRS, right? So Treasury is also the where FinCEN is underneath, right? And so FinCEN, which is important for registering money service businesses and AML and all these sorts of things. To me, this feels like an AML policy, and so it's going to require these non-custodial wallets and exchanges to KYC. And so I think really at the end of the day, that's what the proposed regs are most aligned with, is a new AML/KYC process for non-custodial and on-chain transactions. I really don't think it solves much of an issue with actual tax reporting.
And what do you think that would look like? So from assuming that now MetaMask has to KYC US users, now they have to KYC everyone to make sure that you're not a US user. So do you think that would, the way I see it is I feel like people would find ways, or they would move to chains that allow them to do things without, maybe move towards more privacy coins or things like that. So for me, I think it's more of just like kicking the can down the road. But I also, I think you're absolutely right in that it's more of an anti-money laundering goal, desired outcome than the 1099 reporting, for sure. I think that, but I think it's just, it's a challenge because it's counter to what the industry was built around.
100%. So
yeah.
if, I think it sounds like we both agree, like it would stifle innovation in the US if implemented as written. So what would you suggest, like at a very high level, they tweak so that we did have a reporting regime?
I think that I think that they keep the reporting requirements robust on the centralized exchanges, but I think that the nature of DeFi is hard to regulate in this way. And I think that any type of regulation related to unless you had some zero knowledge identification that you could, I think that like decentralized IDs that are powered by zero knowledge tech would be able to accomplish this, where you're validating that someone is from a certain place without having to reveal any information about them on chain. But I don't know if that would necessarily, I don't understand ZK from a technical standpoint enough to know if this would accomplish the goal while also protecting users. So that's a knowledge gap on my end.
I agree. I think requiring centralized exchanges to report 1099s, I think that makes a ton of sense, right? Like they're already having KYC, AML, all those sorts of things. They have the information at their fingertips. They should already be reporting this information. When you get to DeFi and on-chain transactions, it just gets incredibly complex. And I honestly don't even know if there is a regime that you can put in place that would be effective to require a lot of these non-custodial options to report 1099s.
Because I think that it would be such a burden for these decentralized platforms to implement, and the scope of which it basically encompasses everyone that's decentralized. And I think that what would effectively happen is they would just geo-block anyone from the US is what I think, and then we would just be shut out for that reason, because now they don't want to have to deal with the compliance nature of allowing US users. And I mean, I saw that when I was at TrustSwap, they didn't allow US-based users to participate in launchpads because they didn't want to have the scrutiny of the SEC. So they would just geo-block anyone from the US, they'd KYC everyone, and just ensure that you don't have a US passport or any US presence. And then they'd move forward. And I think that would be kind of similar for how the rest of the industry would move. Is just, okay, if we have to do this for the US, any decentralized platform is probably just going to say, all right, we're going to exclude those users and move on. So that's why I agree with you. I think it should be more on the centralized exchange. And from a practicality standpoint, if you're going to want to use crypto assets, you have to have, and you're a US citizen, you kind of have to have some on and off ramps. So it's hard to avoid the KYC. There's definitely ways around it, but like as we say with privacy coins, there's ways around the AML standpoint as well, if you decide to go that route. So yeah, always going to be loopholes, but I think it's a challenge of, anyways, challenging topic for sure.
Yeah, bringing it full circle. If there's anyone that works in, for the U.S. government in the position to, help, decide what some of these regimes look like, and listening to this right now, how can we, as an industry, help you come up with a regime that is, it is possible to comply with, so that we can create this regulation in the U.S. as opposed to driving this innovation offshore and potentially risking the regulation being developed in a jurisdiction that the US may not be very well aligned with.
Exactly. Pandora's box is open, so we need to kind of operate within it and make sure that we're at the forefront and not losing another industry to other countries. Totally on board. Yeah. We're calling out to you, IRS folks. Listen to the Niche to Necessity podcast. All right. So on the topic of like risk management, kind of going down that same kind of road we're going down, what risk management strategies are necessary for digital asset accounting? What would you say are necessary for that implementation?
Yeah, we've touched on a couple of them so far. So client acceptance policy, right, is going to be super key. That concurring review that we have in place, I think that's also super important in helping us manage our risk. One of the sub ledgers that we work with actually has a risk policy that I really, really like, and was one of the reasons why we chose to go with them. The client actually, when they connect their wallets and exchanges to the sub ledger, they have to check a box that says, I have connected all of my wallets and all of my exchanges, and I certify that everything is complete. And that gives us, right, something to rely on, that the client has provided us everything. So from a risk perspective, that's super key, and would encourage others that are in the space to think about something similar.
So what do you do in the instances where it's like provable on chain that you don't have all the sources? Because I mean, like that happens all the time where you're like, all right, well, you have, 20 ETH going out and you only had 18 coming in. Like, I'm missing some source. What's going on?
Yeah, absolutely. I mean, we'll go back to the client in those cases, even though they've already certified, yes, I provided everything. We'll definitely go back to them and say, hey, it's very obvious that you haven't connected everything. Give us more information. Tell us what's missing, and we'll work with them in those cases.
Okay. Yeah, great. Makes sense. Slap the cuffs on them. They got it wrong. So yeah, I think you've alluded to it a little bit with the use of subledgers and stuff like that. But how do you guys ensure the accuracy and security of digital asset reporting?
Yeah, at the end of the day, I think we trust our clients. Going back to that client acceptance policy that we have a lot of trust in our clients, and we also have a standard that we have to apply to, right? Like we have to make sure that things make sense and are within a normal range, right? So we trust our clients, we work with our clients, and at the end of the day, I think we lean towards wanting to trust them more than not believing in our clients. When it's obvious that things are missing, that's whenever we go back and work with them. We trust a lot of the subledgers that we work with as well. We do our due diligence anytime we onboard a subledger, right? Like it's important that they have a SOC 2 report. We go through and use the subledger ourselves and make sure that it works. And the information that's coming through is reliable before we'll onboard our clients into those. So those are some things that we generally do.
Great. As far as your future outlook for the industry, so what are some of the projections you have for the future of digital assets in the accounting industry specifically?
Yeah, but maybe before I answer this question, I should preface it with none of this is investment advice.
The
So,
old trope. Yeah.
yeah, if you go buy crypto after this conversation that you're listening to here today, and it tanks, it's not my fault. Okay, you can blame
All
that one on
right.
Taylor.
Yeah. All right. It'll be my fault. No, it's not. No, it's not.
All right. So now that we got that disclaimer out of the way, um, I think public blockchains are here to stay, and I'm personally bullish on several different things within public blockchains. One of those being tokenizing real world assets. I think there's probably some need to solve for privacy issues on that one, but once that's solved, I think tokenizing real world assets is going to take off, and we're already seeing TradFi, right, adopt a lot of the things. Like JP Morgan is tokenizing deposits with JP Morgan or JPM coin or whatever you want to call it. And so TradFi is already moving into the space, and there's several other use cases out there, like tokenizing securities. Securitize, I think, is one of the firms in that space. So I'm super bullish on the overall ecosystem being here to stay. Now, I think that there's going to be some winners, some losers, just like the .com bubble, right? A lot of the big market caps will probably be here to stay for a while, similar to like the Googles and the Facebooks and the Amazons and all those types of companies that made it through the decline after the .com bubble. And then, I think being a blockchain or crypto accountant, whatever you want to call it, is eventually going to just be synonymous with just being a regular accountant. Because I think if you work with financial institutions, if you work with tech companies, supply chain companies, manufacturers, they're all going to have some sort of blockchain technology in their normal, day-to-day operations. And so I think you're just going to start to see this a lot more. And so, yeah, I think it's here to stay.
Yeah, I think you're right on. I think that the thing that really made blockchain and the crypto digital asset space click for me was smart contracts. And I think that, as you're stating, every aspect of the business, I think, is going to move towards some sort of on-chain activity, whether it's from supply chain management, whether it's from smart contracts being used as escrow, or whether it's one of the ideas I've had for payroll is payroll vesting, so that if you're on a salary and maybe every day of the week that you work in real time, you're accruing that salary that you can then withdraw from a smart contract, so that you have your money on demand as you earned it. Stuff like that. I feel like it's just a no-brainer, because if you can eliminate the whole payday loan industry just by having a smart contract based payroll system, that's just an idea that I've always thought would be a cool use case for the industry. Stuff like that, I feel like if you can better the business, it's going to all follow suit, and it's going to be ubiquitous. And that's what this whole podcast is about, is that transition from a niche industry to a necessity for accounting and tax professionals, because it's here to stay. And it's a more equitable financial system, I think, than we have right now.
Yeah, that's super interesting. I like that idea. There's a book that I read recently. It's called Ethereum for Business. Have you heard of it?
I've heard of it. I haven't read it.
Yeah, it's a good book. I recommend it, especially because you're in this industry, right? There's a ton of use cases in that book about where this is going and how smart contracts are going to revolutionize the world of business, especially for contracts. If you think about normal contracts in today's world between two companies, when you can just take that, automate it in a smart contract on a blockchain, that's where the author essentially suggests that we're going.
Yeah, I love that. I think that's like, when I first heard about smart contracts, that was like my aha moment. I was like, because I heard about Bitcoin in 2013 when I was at PwC, but I was like, and it was our first year, and some people were discussing it, and I thought it was just like way over my head and didn't think too much of it. But when I finally heard about ETH and smart contracts, that's where I was like, oh, okay, all this makes sense to me. And I think you're right. I think that I got to read that book. I'm going to go pick that up and get into it, because it sounds like a lot more use cases are identified in there as well.
Yeah, it's a good read.
Yeah, cool. So how would you say that accounting firms should prepare for the increasing integration of these assets?
Yeah, here we go again, sound like a broken record. Just invest in understanding how the technology works.
Mhm.
Get your hands dirty. Yeah, and I also think that with public accounting firms, right, I think we've seen a trend recently towards more non-traditional hires than traditional hires, or your traditional CPAs. And I think that in this space is specifically, we'll see more non-traditional hires in CPA firms, thinking about people that have maybe some coding experience or understand Python, or know how
Mhm.
to code a smart contract or audit a smart contract. Things like that, I think, are going to be even more important for firms to target in the future.
Yeah, I interviewed Amber Welch a couple days
Yeah.
ago for this podcast, and she was talking about how she, everyone thought she was crazy when she took a degree in accounting with computer science, 10 or so years ago. And it's like, I feel like that's going to be the golden kind of goose that you're looking for in an accounting firm in the next, within the next 5 years, because people who understand the systems, or systems as they operate in a computer science background, it's going to be extremely valuable in an accounting firm, because things are going to move that way, whether it's through automation, through AI, or blockchain, or whatever. All those skills are going to be super necessary.
Absolutely. And here's another use case for you. I have a degree in accounting and management information systems. So there you go.
There you go. Nice. So any final thoughts on the importance of embracing digital assets in accounting? I know we've talked a lot about this, but any closing thoughts from you?
Yeah, like I said, get your hands dirty.
Mm-hmm.
And if you're listening to this and you're wondering, okay, well, how do I get my hands dirty? Go set up an account on a centralized exchange like a Coinbase or Kraken or Gemini or whatever, one that you feel like you can trust. And then buy just a little bit of crypto. Ethereum is probably a good place to start, to get your hands dirty. Buy an amount that you wouldn't mind if you lost it. It's no big deal. Start with like $25, send it to your own non-custodial wallet, and then connect that into a decentralized exchange, and play around with DeFi, and then maybe connect it to like an OpenSea and play around with NFTs, and just kind of go down that rabbit hole. There's a ton of YouTube videos out there that you can watch to help you. There's newsletters that you can subscribe to, like Blockworks, podcasts like Bankless. And then, if you're in the finance area in crypto, get involved with CryptoCFOs, right?
Yeah, hell yeah. Thanks for the name drop. Yeah, I think that's all really great advice. I think that the experiential knowledge is where it's at, and I think that you're right on with that. So how can listeners learn a little bit more about Forvis, your practice, and the services they offer in the digital asset space?
Yeah, for sure. So Forvis.com. We also have a regular dripping of thought leadership. We call them foresights. That's a little play on our name. So you can go out to our foresights webpage, and there's a tag for digital assets that you can specifically subscribe to just our digital asset foresights. And then I'm very active on LinkedIn. So if you want to also follow me on LinkedIn, I love connecting with people on LinkedIn. You can find me there. Nik Crypto Nik Fahrer is my name on LinkedIn.
Awesome. Well, thank you so much for your time, Nik. I love the work you're doing over at Forvis, and always a pleasure connecting with you. So thanks again for joining.
Yeah, thanks for having me on, and love what you guys are doing at CryptoCFOs too.